It's a pleasure to have you on Business Incorporated IMBC at Debayo. Coming up on today's show, Nigeria's headline inflation eases further in July, and South African President Cyril Ramaphosa proposes new sovereign wealth fund to boost economic growth, and predictions ahead of Egypt's Monetary Policy Committee meeting on Thursday. We'll begin today's show with data from the National Bureau of Statistics showing Nigeria's consumer price index fell by 0.09% to 11.14% year-on-year in July from 11.23% recorded in June 2018. Now, this is the 18th straight decline year-on-year. The food index also fell from 12.98% in June to 12.85% in July, while core sub-index dropped from 10.4% to 10.2%. Similarly, the country's urban inflation eased to 11.66% from 11.68% in June, while the rural inflation rate remained flat at 10.83% from 10.83% in June. And let's head to the stock market here in Africa, where all the major indices are down at intraday. Nigeria's all-share index was 0.54% south, while the South African index was also trending lower at intraday. In Egypt, the EGX 30 was 0.32% negative, also at about midday Nigerian time. The Kenyan index, however, closed up 0.39% on Tuesday. And in the Middle East, Abu Dhabi shares rose 1.1% in early trade, and that's the only market shining in an otherwise lackluster day in the region before the holidays. All the other indices were in the red at intraday. Dubai shares were down 0.8%, while the Qatar index was 0.48% lower at about midday Nigerian time. In Saudi Arabia, which is the region's biggest market, it was also down 0.16%. And in Europe, the shares were mixed on Wednesday as concerns over the Turkish currency crisis continued to affect investors' appetite. Well, let's cross over now to the Frankfurt Stock Exchange, where RBS is waiting to give us more updates from the markets. Orit, it's good to see you again today. The Turkish lira is extending its rebound, and the European stocks inching higher today. Was the Turkish contagion on markets overblown?
It almost seems so when you look at the Turkish lira making leaps and bounds on a recovery, not making good everything that it lost in the past few days, and certainly not what it lost this year. But shares also putting on hold the losses and posting some nice gains. But you know, there are still suspicions, perhaps even fears, that there might be trouble for banks in store. And when you look at individual investors' fates, I just read something today that the ETF, exchange traded fund on the MSCI Turkish market, reflecting a broad range of shares there, halved in value in the past 5 weeks. So individuals are affected by the situation as it stands now. It's also putting some pressure on the euro as investors leave the eurozone on fear of contagion in favor of the US dollar. But the euro being lower is not really something that is bad for the eurozone, but something that is good because it makes exports all that much easier in many markets.
Well, meantime, Orange, a number of analysts believe that the trade war is still a major headwind for the markets as Turkey slams higher tariffs on some U.S. goods yesterday. What's the view from Frankfurt?
Yeah, trade war, whether with Turkey, but especially with the United States and the United States and China, those are the major headwinds for the markets, for the companies, for economies. That is the risk for the second half of the year. It didn't show up much in numbers for the first half because everyone was just motoring along, but it certainly already hurt sentiment. You saw that in polls of financial market professionals here in Germany, for example, or an investor or in corporate confidence. But for the second half of the year, that will be a major topic. Turkey especially won't be something that will hit the Eurozone or Europe as much. And I'm sure the United States will not feel Turkish tariffs on their products very much. But the topic of trade war, that's a very serious one. And the way President Erdogan in Turkey reacted by just also slapping tariffs that makes clear on how much of an instrument this has become, and that's a scary prospect.
And in other news now, the Royal Bank of Scotland has been slammed some stiff penalty to settle civil claims in the U.S. on the misconduct in the period leading up to the 2008 financial crisis. Give us more details on this.
Yeah, it's to settle civil suits in the United States, and the settlement calls for $5 billion being paid by the Royal Bank of Scotland, once the biggest bank in the world, but as the U.S. Justice Department alleges, partly responsible for the financial crisis and responsible for misleading its investors into buying securities that the investors thought were safe, that RBS, Royal Bank of Scotland, said were safe, but in fact harbored risky mortgages, subprime mortgages, and which the investors subsequently, when the market crashed, lost lots of money on. And RBS, the Justice Department says, made hundreds of millions on it. The RBS share, interestingly enough, it's losing a little bit today. It's not tanking. People expecting a settlement like this, it was already in the cards. RBS itself is nowhere near it was before the financial crisis hit. It had to be nationalized in order to save it from bankruptcy. And the state, the UK, the taxpayer, is still in it to the tune of over 60% of the shares today.
Well, thanks, Orich, and do enjoy the rest of your day. We're staying with the markets, but this time in the U.S., where stock index futures traded lower on Wednesday ahead of a batch of economic reports, and as investors monitor Turkey's continuing current